Hey guys, it's Stephen from HDQ Chartered Accountants, and today I just wanted to cover some structuring options that are available to property investors. So let's say you're just starting out on your property investment journey, you've saved up some money and you have enough to buy your first property. What are our available structuring options? So we know that buying under your own name is very straightforward. Everyone's familiar with this. You can buy by yourself or you can buy jointly with others. Some other available structuring options would be buying under a trust, a self-managed super fund, and a company. But let's say that we're now early to mid-30s. We don't really care about self-managed super fund at this point because we know that if we invest into the self-managed super fund, the money is going to be locked up until our retirement. So that could be 60 plus, depending on your retirement age. For companies, we don't really want to consider that in most cases, just because there's no capital gains discount when you end up selling the property, and then you'll end up releasing the profits via dividend to the shareholders, which means that you'll be paying the individual rate of tax at the end of the day anyway. So what we would like to focus on is the trust and the individual purchase at this point in time. We do recommend buying through a trust for your first purchase, just because there are some advantages when it comes to lending. You also might get some benefit of asset protection and tax minimization. So if you're trying to grow a medium to large portfolio, but you're on a fixed income or you don't have much room for your income to grow, what commonly happens is you get stuck around 2 to 4 low value properties, or maybe even 2 medium valued properties. So we understand that it's quite hard to get into the market these days, especially Sydney, with the median price being over $1 million. So what we're seeing these days are a lot of beginner investors are going towards Queensland and WA at a 500 to 600k price point, and I kind of call them yield hunters because what they focus on is the cash flow. So if you're looking for a good property at 6-7% yield, it will help your borrowing capacity in the medium to long term. As long as you use the correct structuring, it isn't going to bottleneck your property acquisition journey. So what we find is, if you continue to purchase under your own name, let's say 2, 3, 4 properties, you're stuck. What tends to happen is you're going to be stuck in a period of paying down your debts. So obviously owning investment property entails paying down your debt, but for how long before it helps your borrowing capacity in order for you to proceed? So what we find that what lenders are allowing is that if you get to a self-sufficient trust position, so let's say we set up trust number 1, your borrowing capacity is set at 500k. If you set up a second trust and you go to the bank again, you say, hey look, can I borrow some more money? They'll run the credit check and they'll say, show me trust 1. If you can prove that trust 1 is trading profitably and there is no reliance on the guarantor to contribute to that trust, it means that that trust is self-sufficient, so the bank doesn't have to consider trust 1 borrowings. So when you go to borrow again for trust 2, that means that they'll assess your position on trust 2 and your individual holdings alone. So what this means is that you can effectively preserve your borrowing capacity in the current lending rules as long as you have enough capital, or there is a sufficient amount of debt or equity in your property in order to be self-sufficient. So it's very important to get the structuring right, because if you don't get it right now, what will happen is you'll hit that bottleneck, and maybe 10-15 years down the line you're going to say, oh shit, I need to restructure my portfolio. And the biggest expense of restructuring a property portfolio is the capital gains that you incur upon sale and the stamp duty upon purchase. So that might unwind a few years of your investment returns. So definitely consider the trust structure if you're a beginner investor. Don't just take the easy way out. Consult an accountant and a mortgage broker before you proceed, and definitely take your time with the decision. You rather do it slowly and surely than regret it 10 or 15 years later down the line. Thank you.